Hello, everyone. In this video, I am going to go over 20 questions that you will likely see on your final exam for Intermediate 2. So I hope these are helpful. And if you are struggling with any of them, please reach out. What my plan is to show you the question, and then I'll give you a couple seconds in case you'd like to pause the video and attempt to solve it yourself. And then I will go over it with you. So let's go ahead and get started. All right, the defined benefit pension plan of Creation Company had a PBO, remember that's the projected benefit obligation, of $269,000 on January 1st, 2020. During the year, pension benefits paid were $46,000. Service costs were $88,000, and the discount rate for the plan for this year was 10%. Plan assets increased during the year by $50,000. The amount of projected benefit obligation at December 31st, 2020 was how much? So let's work through this problem together. We know that our beginning balance was $269,000. And one thing that we're always going to base off of the beginning balance is the discount rate for the plan, which was 10%. So we would take 10% times the beginning balance of $269,000, and that would give us $26,900 as the interest for the projected benefit obligation. So we're always going to add that to the PBO. We also want to take into consideration the service costs for $88,000. That's also going to be added to the projected benefit obligation. We actually don't care how much the plan assets increased or decreased, but we do care about the benefits that were paid, because if we paid those benefits to the retirees, then that is less of an obligation that we have. So we will subtract the $46,000 of the benefits that were paid. So we started with our beginning balance, the $269,000. We add the service costs. We add that 10% of interest. Remember, it's always based on the beginning PBO. And then we subtract the benefits that were paid. We ignore the plan assets that increased by $50,000. So that gives us the answer, which is $337,900 as the ending projected benefit obligation for the year 2020. All right, the next question. Hogan Company had the following account balances for 2021. It gives us the accounts receivable at the beginning and ending of the years, the accounts payable, the prepaid insurance, and then it tells us Hogan reported net income of $370,000 for 2021. Assuming no other changes in current account balances, what is the amount of net cash provided by operating activities for 2021? So we are going to look at, throughout this review, operating activities, financing activities, and investing activities. So make sure you're paying attention to that part. Okay, so how do we work through this one? We have to decide whether or not these three accounts that it gives us would affect operating activities, and if so, would the increase or decrease add or subtract to the net cash flows? So I'll go ahead and pull it up so that we can talk through it. It tells us that the net income was $370,000, and then we see that there was an increase. Remember, this is the beginning balance. Little things you got to make sure you pay attention to that I can overlook, like did they put the beginning balance on the left or the right? So we started with the beginning balance of $34,000. It increased in accounts receivable by $10,000. So let's think about this. If accounts receivable increased by $10,000, that means some of the sales that we made, we didn't get cash for yet. It's still great. We made those sales. But when we're talking about the statement of cash flows, we care about what cash we brought in. So that was $10,000 less in cash that we brought in. So we're going to subtract that from the net income of $370. Then we look at accounts payable. That increased by $9,000. Accounts payable is something that we would pay out for different expenses. If it increased, that means that's less cash that actually left. In this net income number, we showed that $9,000 as expenses or cost of goods sold, but we haven't actually paid $9,000 of that yet. So we need to add that back in because that's $9,000 in cash that we still have. We owe it. Yeah, that's not great. We're going to pay it later, but it's $9,000 in cash that we have not paid out yet that we had shown as expenses up here in net income. Then our prepaid insurance. So our prepaid insurance increased by $6,500. That means we pay the insurance company an extra $6,500 that has not been expensed out yet. Cash went out, but the expense was not reflected in this $370,000. That means we need to reduce it by the $6,500 because that cash did leave, even though it hasn't shown up here yet. So when we take our net income, we subtract out the increase in accounts receivable, we add in the increase in accounts payable, and then we subtract the increase in prepaid insurance, we get net cash flows from operating activities of $362,500. There's a lot that goes into that, and a lot of it is just thinking through it logically. How would this affect the net income? How would this affect the cash? And just take it one step at a time. Don't let it panic you. And remember, whenever we went over this chapter, we had a little chart that talked about the increases and decreases in accounts receivable and accounts payable and how that affects the cash flows. So check that out as well. Next question. On October 1st, 2020, Chewy Corp declared and issued a 6% stock dividend. Before this date, Chewy had 81,000 shares of $5 common stock outstanding. The market price of Chewy Corp on the date of declaration was $10 per share. What is the journal entry for this transaction? Okay, so let me pull over our calculator here, if I can get it to pull up. See where I can put it without it covering up too much. And what I like to do when I do these word problems is sometimes go through and say, what is important? Okay, October 1st, that seems like it could be important. The name of the company, you know, yes, if we're dealing with multiple companies, then we're going to need to know that. But otherwise, like, don't get tied up on that. We care about the 6% of stock dividend. We care about how many shares they had and so on. So it tells us that the par value of the common stock is $5. And we have 81,000 shares. Well, that's not what I was trying to do. I'm trying to get this out of the way here. So we have 81,000 shares times the $5 par times the 6%, because that is the stock dividend that they're issuing. So what that's going to do is that's going to increase our common stock by 24,300. We took our common stock par value times the number of shares times the stock dividend percentage. But we're actually selling these, the price, the market price on the date of declaration was $10 per share. So double what the par value was. So then we're just going to double this to see how it's going to affect our retained earnings. So let me pull up what the journal entry would be. So if you just took 81,000 shares times the market price times the 6% dividend, you would get the retained earnings. We're decreasing retained earnings whenever we issue a dividend, whether that's cash or stock. Half of that, because half of the market price is what our par value is, half of that is going to be the 24,300. That's how much our common stock is increasing by. because they're not issuing cash dividends, they're issuing stock dividends. Then we increase the paid-in capital excess of par by the same amount, half of the $48,600, because that is the extra, the additional from the market price over the common stock par value. All right, we're going to move to the next question. Use the following information to determine this company's taxable income considering a 25% tax rate. So we have the pre-tax accounting income and then what was included in that compared to here we have the maker's depreciation for tax purposes. So let me give you a second to try to determine what would be the company's taxable income. All right. So we have accounting income of 190. That's what we put on our income statement. But remember, for tax purposes, sometimes that differs on what the government wants us to pay taxes on as far as income. So here we start with what our income statement shows. Then we say the permanent difference, see here, the overweight fines, they subtracted that to get to the 190, to get to their net income. But the government says, no, 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 you don't have fines issued by the government and get to reduce your taxes by that amount. You need to add that back in permanently. So we increase those fines, we increase the net income by the fines. Then we have the temporary difference of depreciation. So for the income statement, we had depreciation expense of 61. But for tax purposes, we're doing an accelerated method using makers, and we have 97. So we're going to find the difference. 97 minus 61, that gives us 36. And since we are accelerating it and we're going to depreciate more for tax purposes, we get to subtract that from the taxable income, and that brings us to 162. This is one of those things where you got to pay attention to exactly what it's asking. It gives us a 25% tax rate, but it doesn't ask what are the taxes due or the taxes payable. It asks what's the taxable income. So really, we didn't even need to know that 25% tax rate. All right, let's do an easy one. What is the effective interest rate for this lease? All right, so when you see one of these charts, you should be able to figure out the different interest rates pretty easily. The effective interest rate, we're going to go to the effective interest dollar amounts, and then you'll divide it by the outstanding balance the period before. It doesn't matter if you choose the 8th period and you divide it by the 7th period outstanding balance, or if you choose the 2nd period effective interest and divide it by the 1st period outstanding balance. It doesn't matter. It's going to give you the same amount, which is going to be 8%. So I had taken the $6,996 divided by this outstanding balance of $87,456 and got 8%. Just for fun, let's try if we did a random one. We did period 6, 4,472. And we divide it by the prior outstanding balance, 55,897. Again, we get 8%. So that's going to be our answer regardless. And the way I set this slide up is a little unusual. There's the answer. It's coming, and somehow I set it up as leaving as well. So hopefully you got that one. All right. Cinderella Company leases glass shoemaking equipment, how ironic, to customers under a sales type lease. The equipment has no residual value at the end of the lease, nor do they contain purchase options. Cinderella Company desires a return of 11% interest on a 4-year lease of the equipment with a fair value of $795,564. The present value of an annuity due of $1 at 11% for 4 years is 3.444. What is the total amount of interest revenue that Cinderella will earn over the life of the lease? Whew, that is a doozy of a question. Go through, figure out what you need, and then we'll work through it together. All right. So what we want to do here is figure out first, what are the payments going to be? And then we'll see how much in excess are they making in payments over the fair value, and that difference is going to be the interest earned. So the annual payments, you're going to take the fair value of the equipment and divide it by the present value factor. They already gave that to us, which was super helpful. And the reason we use annuity due is because the first payment was due on the first day of the lease. This tells us the annual payments are $231,000. Just like a mortgage, you're going to pay more than what the actual price of the home is because there's interest included in that. So it tells us that they are making 4 payments, 4-year lease. So they're making 4 payments of $231,000. So when we multiply 4 payments times the $231,000 total, they are going to be paying $924,000. $924,000 minus the fair value of the equipment is $128,436. All of that is the 11% interest that they were charging. So ultimately our answer is $128,436. Okay. Speedy Enterprises issues a 20-year, $1 million bond that pays semi-annual interest of $50,000. If the effective annual rate of interest is 12%, what is the issue price of the bonds? Some relevant and irrelevant present value factors are as follows. So this is where we have to figure out how much are they actually selling the bond for. We know that bonds are sold at premiums or at discounts. So we need to determine based on the 20 years, and it tells us that it is semi-annual interest. So it'll be 40 periods, 20 years times twice a year that they're making an interest payment will be 40 periods. So we know we're going to use one of these. Well, we're going to use both of these where the periods are 40. And the reason we're using 6% interest is because they're getting 12% a year. They're getting 6% the first time, 6% the second time. We do not need either one of these top 2 present value factors. So I'm going to pull this up here so you can see it. We're going to take the payment, the $50,000 that they're going to get every 6 months, the semi-annual interest of $50,000, times the present value of an ordinary annuity at 40 periods and 6%, which is 15.0463. We multiply that, the present value of those 40 payments is $752,315. Well, they're not only getting the interest payments, they're also going to get the $1 million at the end. So we're going to take the $1 million. This time we're saying, hey, it's not over and over. It's not an annuity that they're getting this amount. They're getting it one time. We're still going to use the 40 periods at 6% because it does make a difference with compounding. We'll multiply it times 0.09722. We get the present value of that $1 million 40 periods from now. Wow, that's a big difference, is $97,220. Then we add those 2 numbers together to get $849,535. So this $1 million bond apparently is not paying as much interest as they could find in the market, as investors could find in the market otherwise. So they're selling it at a huge discount. I would love to be able to find these interest rates. Come on. All right. In 2019, Montana Company reported quality assurance warranty expense of $197,000, and the warranty liability account increased by $25,000. What amount of warranty costs were paid during the year? Okay, so all we're going to have to do here is we're going to take our warranty expense and we're going to subtract out the amount that the warranty liability account was increased by. So that means our expenditures that we actually paid were $172,000 because part of this expense was the amount that was put into the liability account. So they didn't actually pay those out to the customers yet. They're just putting it on reserve because they expect, due to past experience, that they're going to have to pay their customers or replace parts or something. All right, Twigs Inc. has $18.7 million of notes payable due on April 12th, 2022. At December 31st, 2021, Twigs signed an agreement with First Bank to borrow up to $18.7 million. They're saying, hey, we want to go ahead and borrow the whole amount and refinance it on a long-term basis. The agreement specified that borrowings would not exceed 70% of the value of the collateral that Twigs provided at the date of issue of the December 31st, 2021 financial statements. The value of Twigs collateral was $19,600,000. On its December 31st, 2021 balance sheet, Twigs should classify the notes as follows. So you're going to have to determine how much is going to be short-term, how much is going to be long-term. All right. So this one's actually not too hard, even though it looks really challenging. But they are wanting to refinance this whole $18,700 to be a long-term note, because right now it's going to come up as a short-term note. But the bank said, no, we only will do 70% of your collateral. So 70% times 19,600, which will give us 13,720. So they can refinance this 13,720 on a long-term basis, but the short term is going to be the difference, the extra. They said, no, we're not refinancing the whole 18.7. So anything we didn't refinance is going to be short term. Next question. Ezra Corporation purchased debt securities during 2021 and classified them as securities available for sale. How much gain will be reported by Ezra in December 31st, 2021 income statement relative to the portfolio? So it gives us the cost of each security, and then it gives us the fair value. So take a second and see if you can figure out how much gain would be reported on the income statement. So if you came up with the answer of 0, you were correct. If this would have been trading securities, we would have shown that the difference between the fair value and the cost was a gain on the income statement. But for available for sale or held to maturity, we would not show that. We would show available for sale the difference in the other comprehensive income. We're not showing it on the income statement until it's sold. So it would be $0. Okay, here's a long one. You know, I got into accounting because I didn't really like reading, and here I sit reading word problems over and over again. All right, on June 30th, 2021, Facts of Life Industry had outstanding 86 million of 6% convertible bonds that mature on June 30th, 2022. Interest is payable each year on June 30th and December 31st. The bonds are convertible into 7 million shares of $10 par stock. At June 30th, 2021, the unamortized balance in the discount on bonds payable account was $4 million. Also, half of the bonds were converted when Facts of Life's common stock had a market price of $29 per share. When recording the conversion, they should record what entry? Okay. So we're going to take into consideration that they are going to be able to convert these bonds. They've decided to convert half of those. So we need to look at half of all the stuff we have going on, take it out of bonds payable, and put it into common stock. So we have $86 million in bonds. All right, bonds payable. All right, they're converting half of those. So let's get half of it out of there. So bonds payable is a normal credit balance. We're going to debit bonds payable for half of the 86 million. We also know that there was a discount. If it's a discount on bonds payable, that's a contra liability. So that would be a debit to discount on bonds payable. We want to get rid of half of that. So we're going to credit discount on bonds payable for half of the 4 million. Then we're going to look at the common stock and the paid in capital in excess of common stock. And we are going to, let me find my handy dandy calculator here. So it gives us the current market value, the $29, but it also tells us that the par was $10. So we've got 43 million times $10 times the 6%. Well, the 7 million shares. That's what we're looking at. I'm making this whole thing more complicated. The bonds are convertible into 7 million shares. We're going to have half of those shares at $10, and that's going to give us the 35 million. Because if we took 7 million times $10 par, that would be 70, but we're only doing half. So that will give us the common stock that they're converting it to. The excess is going to be the paid in capital. So you can add these two together, get 37, subtract that from 43, and get the excess amount. Hopefully you're holding on strong. I know this is a long video, but this will help you out in your final exam. Maybe pause it, take a break, walk around your house a couple times and come back. All right, next question. Wildcat's company had a decrease in deferred tax liability of 30 million, a decrease in deferred tax assets of 20 million, and an increase in tax payable of 110. The company is subject to a 25% tax rate. What is the income tax journal entry for the year? All right. So we know that anytime there is a tax entry, you are going to have a debit to income tax expense and a credit to income tax payable. And if there's any change in the deferred tax assets, deferred tax liability, that's going to show up in between there. So again, we don't care about this 25% tax rate. That's not what we're recording right now. Or it's already calculated in that because it's telling us the tax payable. They've already taken that 25% into consideration. So they give us the income tax payable, which is always a credit to income tax payable when recording the income tax journal entry for the year. It also tells us, gives us all the information we need pretty much. It tells us that the deferred tax liability of 30 million decreases. If it's a liability and it's decreasing, then we're going to debit that. The deferred tax asset also decreases. If it's an asset and it's decreasing, we're going to credit that. So really all we have to do is figure out the missing one, which is always going to be a debit to income tax expense. We could have added the 110 tax payable plus the 20 in deferred tax asset. We get 130. Subtract out the 30 in tax liability, and bam, you've got your income tax expense. So it's really just plugging in these three where it tells us they go, and then figuring out this last figure. During the current year, Stark Industries had prepaid accounting income of $47 million. Stark's only temporary difference for the year was rent received for the following year in the amount of $12 million. Stark's taxable income for the year would be how much? You got this one. This one's way easier than a lot of them we've done already. All right, so the pre-tax income from the income statement was $47 million. The $12 million was for money received for rent, and we're not providing that service until next year. Well, while for financial purposes, we say that's not income, that's unearned revenue. We can't put that on our books yet. We just need to set the cash aside and show it as a liability for unearned revenue. The government says, you got $12 million in cash. You better pay us some of that. So we're going to have to show our net income of $47 million and then add this temporary difference, which will increase our taxes this year, but creates a deferred tax asset for future years, for next year in this case. So we're just going to add those two together. Dublin Inc. had the following common stock record during the current calendar year. So we've got the outstanding common stock at the beginning, then they sell additional shares June 30th, and then even more on September 30th. A 12% stock dividend was paid on December 1st. What is the number of shares to be used in computing the basic earnings per share? So they don't even need to know the earnings per share. We'll see one like that in a minute, but they don't even need to know that in this case. They just say, hey, what is the number of shares we're going to use? Because remember, we're going to use the weighted average of the shares throughout the year. So this 2.3 million shares, that was there since the beginning. So we're going to use 100% of that. Then June 30th, exactly halfway through the year, how convenient for us, they're going to take half. I'm going to put this up here so you can see what I'm talking about. All of the 2.3, they're going to take half of the amount issued at June 30th. Then on September 30th, they still had 3 out of 12 months left, so 25% of the year left. So we're going to multiply 3 out of 12 months times 130,000. Those are the number of shares we had. That was the average. But then on December 1st, now see, that's a key that happened after all of this, so we don't need to plug it in somewhere randomly. After all that, they issue a 12% stock dividend. So we're going to take all of this average and then multiply it times 112% because it's all of these plus another 12%. And that will give us, so this should not be a dollar amount, I apologize, 2,685,200 shares, not dollars, but shares. All right, Plum Corp purchased a machine costing $184 million at the beginning of 2018. Oh my goodness. The machine was being depreciated over a 10-year life using the sum of years digits method. Accumulated depreciation at the end of 2020 was $86.4 million. The residual value is estimated to be $8 million. At the beginning of 2021, Plum decided to change to straight line method. What will their depreciation expense be for 2021? For some reason, this is my favorite kind of problem. Probably because it's not super hard, but I'm just going to go ahead and show you the calculation so we can walk through it. We're going to take the assets cost, the $184 million. We're going to subtract out what they have already depreciated. So that gives us $97.6 million that has not been depreciated yet. But since we're going to use straight line depreciation, we don't need to depreciate the residual value. We want it to still have that worth at the end. So we're going to subtract that out. So then that gives us $89.6 million that we need to depreciate. And they're dividing that by 7 years because it tells us it's a 10-year useful life. And they started depreciating at the beginning of 2018. So we had all of 2018, all of 2019, all of 2020, and now we're at the beginning of 2021. So we've already depreciated 3 years. So we divide that amount that still needs to be depreciated by the 7 years remaining, and that tells us Our depreciation for 2021 and going forward is $12.8 million. At the beginning of the current year, SCBT purchased 25% of High Tech Inc. for $52 million. None of that's relevant. I'll go ahead and tell you that. At the time of purchase, the carrying value of High Tech's net assets was $86 million. Also not relevant for this question. The fair value of High Tech's depreciable assets was $10 million in excess of their book value. That is going to be important. For this year, they reported net income of $86 million, and they declared and paid $10 million in dividends. The total amount of additional depreciation to be recognized by SCBT over the remaining life of the asset is how much? There is a ton of stuff we don't need to figure this answer out. Really, all we need is the fact that they have $10 million in excess of their book value, that's depreciable assets, times the 25% that they purchased. That's all you got to do to figure out how much is the additional depreciation. All right. Dad Company had 36 million shares of $2 par common stock outstanding at January 1st, 2021. In October 2021, Dad Company's board of directors declared and distributed a 2% common stock dividend when the market value of its common stock was $58 per share. In recording this transaction, what would Dad do? So here, it would give you options of which one to choose, but we're going to take the shares to be distributed, which is 2% of the common stock dividend, times the 36 million shares. So that's 720,000 shares. And in this case, they wanted to figure out, it's going to give you the options, and it was going to give you debiting or crediting retained earnings and for how much. What we're doing to retained earnings is we're taking the 720,000 shares times the market value per share, and that's what we would be debiting retained earnings for. We did a very similar one right at the beginning of this video, but we had to actually do the whole journal entry. In this case, they're just wanting to know this one part of the journal entry. Okay. Up and Away Travel Company reported net income for 2021 in the amount of $94,000. During the 2021, Up and Away declared and paid $2,525 in cash dividends on its non-convertible preferred stock. That's important. Up and Away also paid $14,000 cash dividends on its common stock. Up and Away had 44,000 common shares outstanding from January 1st until 14,000 new shares were sold on April 1st, 2021. What is their basic earnings per share? So this was done in one of the more recent chapters. We've already looked at one where we just had to find the weighted average of the shares. This one we need to do the full calculation. So the numerator is going to be the income available for common shareholders. Well, in this case, we have to take the income minus the amount that the preferred shareholders get. We don't need to do anything with this 14,000 for the common stock. All we care about is the income minus anything that the common shareholders don't have any right to, which is what the preferred shareholders have. So that's what we did for the numerator. Then for the denominator, we already did one more challenging than this in this video. We're going to take the 44,000 shares that they had at the beginning from January 1st, and then we are going to add the 14,000 new shares, but we're going to consider they only had those issued for 9 out of 12 months. So that gives us a weighted average of common shares of 54,500. Which gives us an earnings per share of $1.68. 2 more questions left. You guys are doing excellent. I'm assuming, I don't actually know, but we'll see with your test, right? During 2021, Hope Company engaged in the following activities. So we've got different dividends and payments to retire bonds and so on. In Hope's statement of cash flows, what were net cash outflows from financing activities for 2021? So remember, I told you this is going to come back up. We had operating activities at the beginning of the video. Now we have financing activities. All right, so not all of this has to do with financing. So you just have to go through and determine which ones of these is for financing activities. So the distribution of cash dividends is going to be a decrease in cash. They're paying this out to the shareholders. And this is financing because these are shares that they issued in order to bring in money, to bring in some capital. Now, the next one is the fair value of shares issued in stock dividend. Stock dividend has nothing to do with cash, so do not include that one. The payment to retire bonds. Okay, so we issued bonds at some point and we had money come in. That was a financing activity. So paying that back is going to be an outflow of cash for financing activities. So we want to subtract that $658. And then we have proceeds from the sale of treasury stock. So we are selling treasury stock. That's a financing activity. So we are going to add, it said proceeds from the sale. We're going to add that in to have a negative cash flow of $640,000 or, well, $640 that have to do with financing activities. Final question. Information from Mango Corporation's accounting records and financials for 2021 are below. Now they want to know what's the cash flow for investing activities. All right, so only 3 of these qualify as investing activities that have to do with cash. The first one, cash paid to acquire machinery. That is an investment. When you buy machinery, that is an investment and cash was paid, so that's a negative amount. We acquired some common stock. Nope, that's not going to be an investing activity. Proceeds from the sale of land. Yes, they sold land that at some point was an investment. Proceeds mean they got some cash coming in, so that's going to be a positive amount. Gain from the sale of land. Oh, that's one of the trickiest things about the cash flow statement is what do you do with the gains from the sale of the land? Remember, we don't include that in here because that was wrapped up in that 95 just above. That was wrapped up in the proceeds of the sale. If we put the gain and the proceeds, we'd be duplicating 54 of that. Investment revenue received. No, we're going to show that as operating. Cash paid to acquire office equipment. Yes, that's another investment. So we are showing that cash went out. So they had negative cash flows of $26. I hope that this review was very helpful to you. Please let me know if you have questions and good luck on the final exam.